Welcome back to the Deep Dive. Today we're going deep on intangible assets and how these kind of, I guess you could say, non-physical assets are dealt with under IFRS, so that's International Financial Reporting Standards, specifically IAS 38.
Yeah.
You've given us some really in-depth sources here, lots to unpack, but I think our mission today is to really pull out what are the key issues and debates around how these assets, which are becoming more and more important to how companies actually generate value,
Right.
are treated from an accounting perspective.
Yeah, I think that's exactly right. And, I think your sources do a really good job of exploring kind of that core pension that exists, right? How do you measure something? How do you recognize something you can't actually touch? And then, kind of what are the implications of that? And so we'll be looking at how these accounting rules actually then impact what you see on a company's financial statements. And then also looking at the way companies are talking about these assets and some of the challenges and differences that you see in practice. But I think, for anyone trying to understand businesses today and what actually drives value, this is a pretty essential topic.
Yeah, absolutely. And just to jump straight into it, I think one of the things that struck me going through the material is that you've got this kind of fundamental difference, right, where how intangible assets are accounted for is different depending on whether a company acquires them or generates them internally.
Yeah.
And it feels like that would make it so difficult to actually get a clear picture when you're comparing different companies.
It absolutely does. This is a kind of a key criticism or area of concern that investors often raise, is that the accounting makes it really difficult to have a like-for-like comparison between, let's say, a company that's gone out and purchased a brand versus the company that's built up a brand organically over time.
Right.
And so you have the situation where, one company might have a very significant asset recognized on its balance sheet,
Yeah.
and another company, even though they may have an equally valuable brand, it's not going to be reflected in their financial statements in the same way.
At all.
Yeah.
Yeah.
And so, this is one of the reasons why analysts and investors often look beyond, just the reported numbers in the financial statements to try and get a better understanding. And then, on top of that, we have to remember that IAS 38, generally requires there to be an active market
Right.
in order to use fair value.
Yeah.
And an active market for these unique assets, things like brands or patents, often just doesn't exist.
Right. Right. And it seems like to even start to unpack all of this, we need to be very precise in the language that we use. Because one of the sources highlights the need for a consistent terminology when we're talking about intangible assets.
Yeah.
So what does that mean? And why is that so important for investors to understand?
Yeah. So, we're dealing with concepts that are by nature pretty complex, right?
Yep.
If we don't have a shared understanding of what we actually mean when we say things like intellectual property or know-how, or even, distinguishing between the different stages of creating an intangible asset, like the difference between research and development, then it becomes almost impossible to have a meaningful discussion about how we account for these things.
Right.
So this lack of precision can really create a lot of confusion and can make it harder for investors to interpret what they're seeing in the financial statements.
Okay, so we've talked about kind of the practical challenges of actually trying to, recognize these assets and put them on the balance sheet.
Yeah.
The sources also bring in the perspective of academics who've been studying this. So
Yeah.
I'm kind of curious to get your take on what are some of the big takeaways from the academic research that investors should be aware of?
Yeah, so broadly speaking, the academic literature kind of falls into two camps on this. You have, some academics who strongly believe that current financial statements just don't do a good enough job of capturing the real value of these internally generated intangible assets.
Right.
They would argue that, this is because the accounting rules haven't kept pace with the way value is actually created in today's economy.
Right.
So, they're pushing for changes in the way that we recognize, in the way that we measure, in the way that we disclose these assets in the financial statements.
But then there's this other argument, right, that the income statement, in a way, already provides the information. Can you talk a little bit about that?
Yeah. So the counter argument essentially goes that, look, even though these internally generated intangible assets may not be showing up as assets on the balance sheet, the cost to develop them, like research and development expenses or marketing expenses, are being reflected in the income statement. So the argument is that, in a way, investors are already seeing the financial impact of those activities. So, I think it's important to note that even though they're arguing that the information's there, even the folks that hold this view generally agree that there needs to be much better disclosure.
Right.
So regardless of whether it's recognized as an asset or not, there's a pretty strong consensus that companies just need to be doing a better job of providing more information about these intangible assets.
Okay. So that brings us to what the IASB is considering, right? So that's the International Accounting Standards Board, the folks who are behind IFRS.
Mm-hmm.
It sounds like they're at the very early stages of trying to figure out what a project on intangible assets might actually focus on.
Yeah. I mean, they are very much in the fact-finding mission stage right now, trying to really define what are the core problems.
Okay.
And they're asking some pretty fundamental questions about the scope of any potential changes. So, for example, should they be focusing very narrowly on just how intangible assets and the related expenses show up in the financial statements themselves?
Right.
Or should they be taking a much broader view, maybe even looking at intangible items that currently don't meet the definition of an asset under IFRS?
That seems like a huge difference in terms of what investors would see and have to consider.
Okay.
So they might be looking at, beyond just the balance sheet or the income statement.
Yeah, exactly. And then they're also asking what kind of information should they be looking at? So should it be limited to, just the details about the intangible assets that are already recognized, such as their useful lives or how they're amortized?
Right.
Or should they be going broader and looking at, other information that companies might be tracking internally, things like customer numbers or net promoter scores, which is a measure of, customer satisfaction.
Okay.
And then, crucially, they're looking at which types of intangible items should be the focus. So is it the intangible assets that are already recognized, the ones that aren't recognized, or even things like, a skilled workforce, which currently isn't recognized as an asset under IAS 38.
Right.
So there's a lot of different directions this could go.
It really does feel like they're trying to wrap their arms around the whole problem.
Yeah, they're trying to figure out, what are all the angles here?
Yeah.
And importantly, they've made it very clear that they're not looking for solutions at this point. What they need right now is input from stakeholders, whether that's investors, preparers, academics, really anybody who's got a vested interest. First, is their initial list of potential topics comprehensive? Are there things that are missing from that list? And then, which of these problems are the most pressing? Where do they really need to be focusing their attention?
Okay.
And I think a key concern that they've raised is, are the current requirements in IAS 38 really adequate for dealing with kind of new ways that companies are accessing and using intangible items? So, one example might be cloud computing arrangements. How do these rules really apply to those sorts of transactions?
Yeah.
And are they really reflecting the underlying economics of those transactions?
So one of the sources you provided presents, I guess you could say, an alternative way of thinking about intangible assets. And I really liked how they approached it. It's not just about kind of slapping more intangible assets onto the balance sheet. And this source really emphasizes the fundamental link between the balance sheet and the income statement through the double entry accounting system. So can you talk a bit about that and how this source approaches this challenge?
Yeah, absolutely. So I think the source really highlights something that I think is often missed in these discussions, which is that recognizing an asset on the balance sheet directly impacts how we measure value creation in the income statement.
Okay.
And that's because of this double entry bookkeeping system.
Right.
So every time you make an entry on the balance sheet, you're also making a corresponding entry somewhere else. And it's either going to be in the income statement or the statement of cash flows.
Right.
So if you decide to recognize an asset, you're going to be impacting how you measure profitability. And I think a central idea here is this concept of uncertainty, right? We've talked a little bit about uncertainty already.
And this is definitely a recurring theme when we're talking about these types of assets.
Yeah, and I think the source suggests that how we deal with this uncertainty is really what should be driving how we think about the accounting. So they highlight, two specific features that they think are really important for deciding whether something should be recognized as an asset on the balance sheet. First is this expenditure requirement.
Okay.
So the company has to have spent money on this item. And the second is separability. So they have to be able to, clearly identify that expenditure separately from other transactions.
Okay.
And they propose that actually these spending-related features are more important than whether the asset is physically tangible or not.
So it's not so much about what it is, but how it was acquired or created.
Yeah, exactly. And I think it's kind of a different way of thinking about it. It's less about the nature of the asset itself and more about, how did it come into being?
Right.
Was there an identifiable expenditure? And the source also argues that, really, the main purpose of accounting should be to inform on the performance of the business model.
Right.
And they kind of draw this comparison to how IAS 16, which deals with property, plant, and equipment, defines tangible assets by, essentially what they do. And they kind of contrast that with IAS 38, which they argue doesn't really have that same kind of clear, ostensible purpose.
Okay. So your sources dig into the kind of, why is it so difficult to put internally generated intangible assets on the balance sheet?
Yeah.
And they highlight some specific problems, and it seems like the uncertainty around future revenues is a big one for investors to understand.
It is. I mean,
Yeah.
this is one of the core issues, right? So, let's take the example of a pharmaceutical company developing a new drug. So, they spend a lot of money over a number of years researching, developing this drug. And then, it fails in clinical trials.
Yeah.
So what happens? Well, they might have an asset on the balance sheet that's not actually going to generate any future economic benefits.
Right.
And that creates all sorts of problems in terms of, how do you amortize that asset? How do you determine its useful life?
Yeah. It seems like it would be a very subjective exercise.
It can be. And it can lead to, the reported earnings, not really reflecting what's going on in the business, because you might end up having to write down that asset later on and take a big impairment charge. So it creates a lot of volatility and uncertainty.
Okay.
Now, the other side of that coin is that if you were to expense all of those costs immediately, well, then you have a different problem, which is that you're recognizing the expense before you've recognized any of the potential revenue. Yeah.
And so, that's not a great matching either.
Right.
So it's a really tricky situation.
And then there's this other point that you touched on a bit earlier, but it seems like the spending requirement. What about valuable intangibles that might not actually involve clear, identifiable spending?
Yeah, this is a great point. So, think about things like the relationships and networks that a company builds.
Mm-hmm.
So, what people might refer to as social capital.
Right.
Or even, the combined knowledge and skills of its employees.
Right.
These things can be incredibly valuable to a company. But it's very difficult to tie them back to specific expenditures. How do you measure the cost of building a relationship?
Right.
It's not always that simple. And so this makes it very difficult to recognize those things on the balance sheet under the current rules, which often focus very much on, the cash that goes out the door, the investment that's made, and then, the return that's generated on that investment. Okay. And then there's also this challenge of separability for investors, right? Like being able to actually separate out the investment component of expenditures.
Yeah, and I think advertising is a great example of this. So, when a company runs an advertising campaign, some portion of that is really aimed at generating immediate sales, right? You see the ad, you go out and buy the product.
Yeah.
But then, another portion of that is really about building long-term brand recognition. It's about creating that kind of emotional connection with the consumer.
Right.
And so trying to separate those two and saying, well, this much of our advertising spend was really creating a brand asset, that's really difficult and it's very subjective.
Yeah.
And that lack of separability, it makes it very difficult to use, the cost of creating that asset as a reliable way to measure it.
Right. And then finally, the sources touch on this idea of control and how that can affect whether an internally generated intangible can even be recognized as an asset.
Yeah, so control is a key part of the definition of an asset under IFRS.
Okay.
And so for some of these internally generated benefits, let's say, for example, the skills that an employee gains from training.
Okay.
Or a talented employee who, isn't tied down by an employment contract, the company might not actually have sufficient control
Right.
over those benefits because, that employee could walk out the door the next day and take those skills with them.
Right.
And so if you don't have that control, then it doesn't meet the definition of an asset.
Okay. So given all these difficulties in recognizing these internally generated intangible assets on the balance sheet, it seems like, providing more information, what we call enhanced disclosure, might be a more practical path forward for investors to at least get a better sense of what these assets are and how important they are.
Yeah, and this is an argument that you see in several of the sources. So the idea is that, look, even if we can't reliably put a specific number on, some of these intangibles on the balance sheet, giving investors more detail in the notes to the financial statements or in management's discussion and analysis can still be really helpful in understanding what's actually driving value in the business.
And there's been research, right, suggesting that this kind of additional information can be helpful for investors?
There has. So there's been some academic research, particularly in specific industries, showing that when companies disclose more about their intangible assets, it does have what's called value relevance. So that's just a fancy way of saying that the information is actually reflected in the company's stock price.
Okay.
So it's actually useful to investors. And then there have also been some suggestions for more standardized disclosures at an industry level. So the thinking there is that, look, certain types of intangibles are very
All
common
right.
within a particular industry. So, if you're looking at software companies, the key intangibles are going to be things like software, patents, their developer team, their brand. And so having a more consistent way of reporting on those within that industry could be very useful for investors when they're trying to compare different companies.
Yeah, that makes sense. To kind of, I guess, make some of these ideas a bit more concrete, the sources provide a few examples and case studies. And I thought the one about the IFRS Foundation's bound volume, which is kind of interesting because it's, a book of their accounting standards. Is that something we should think of as a tangible book or an intangible asset?
Yeah, and I think this is kind of a perfect example of where the lines can get blurry.
Yeah.
So, it's a physical book. You can hold it in your hands, but clearly the real value of that is in, as one of the sources puts it, the knowledge embodied in it.
Right.
And so, I think it really highlights the challenge of, categorizing an asset when the intangible aspect is clearly the most important part.
And then there's this comparison of how Airbus and Boeing account for their development costs. And what does that show us?
Yeah, so this is interesting because this highlights kind of the different ways companies deal with costs that have both physical and non-physical elements. So developing a new airplane. So, Airbus reportedly tries to separate the tangible and intangible costs and capitalize those that meet the criteria under IAS 38.
Okay.
So, the software development costs, for example, might be capitalized, whereas, the cost of the raw materials to build the plane would be expensed. Whereas Boeing uses something called program accounting, where they recognize all of the costs associated with the program
Okay.
and then spread those costs out over each aircraft that they produce. So it's kind of more of a total cost allocation approach.
Got it. And then there's a really good example, I thought, with a hypothetical company that one of the sources looks at in detail. So what does this show us about the kind of current reporting practices for intangible assets?
Yeah, so this case study is really helpful because it gives you a kind of a snapshot of a company's balance sheet and income statement,
Right.
along with, some key performance indicators that aren't financial. And so you can kind of start to see the different types of information that are being provided. And I think what really stands out is the mix of intangible assets that are recognized and those that aren't.
Okay.
So they've got brands and patents that they've acquired from other companies, and those are recognized on the balance sheet.
Yeah.
They've also got development and research costs that they've capitalized. Now, we have to remember, under IFRS, typically research costs are expensed. So the fact that they're capitalizing some of those is notable. And then they've also got some very significant internally generated intangible items, so their own brands,
Okay.
customer lists, and patents, and none of those are recognized on the balance sheet. So even within the framework of IFRS, there's a fair amount of, I guess you could say, flexibility for companies to decide how they want to account for some of these things, which could make it very challenging for investors to really compare them apples to apples.
It absolutely can. And, this case study goes on to kind of compare this company's stock market valuation to others in their industry.
Right.
And it kind of hints at the fact that, look, the market might actually be taking into account these unrecorded intangible assets,
Right.
When they're valuing this company. So even though they're not showing up in the financial statements, there's a recognition that, they exist, they have value,
Right.
and the market's kind of factoring that in. And then the other interesting thing about this case study is the inclusion of these non-financial metrics. So things like, metrics related to innovation or employee skills or customer focus. And so I think it really highlights this point that,
Right.
Some people have made, which is that, you need to look beyond just the financial statements.
To really get a complete picture of value creation.
Okay, so let's dive into the specifics of IAS 38 itself now.
Mm-hmm.
So what's the kind of fundamental definition of an intangible asset that investors should be aware of?
Yeah, so IAS 38 defines an intangible asset as an identifiable non-monetary asset without physical substance.
Okay.
Now, there's a lot to unpack in that definition, but, essentially what they're saying is it's something that, you can separate and distinguish from other assets. It doesn't have a fixed monetary value, so, it's not cash or receivable,
Okay.
and it doesn't have a physical form. And importantly, the entity has to control the asset.
Right.
And they have to be able to demonstrate that they have the right to obtain the future economic benefits that are expected to flow from that asset.
So it's not just about identifying something that's non-physical. There has to be some level of control and future benefit.
Yeah, absolutely.
Okay.
Yeah.
And so what are some of the key hurdles that companies have to overcome to actually recognize one of these intangible assets on the balance sheet?
Yeah. So IAS 38 lays out two key recognition criteria. The first is that it must be probable
Okay.
that those future economic benefits that we talked about are actually going to flow to the entity.
So some level of certainty.
Yeah, exactly. And the second is that the cost of the asset can be measured reliably.
Okay.
So, if you can't measure it, you can't recognize it.
Got it. Now, for the intangible assets that are generated internally,
Yeah.
IAS 38 makes this distinction between the research phase and the development phase, which seems important.
It is. And this is actually where a lot of the complexity and the debate really comes in. So research costs are always expensed as they're incurred.
Okay.
So, if a company is doing basic research, trying to come up with new ideas,
Right.
those costs are going to hit the income statement immediately.
Okay.
However, development costs can be capitalized. So they can be recorded as an asset on the balance sheet, but there's a big but.
Okay. What's the but?
Only if the company can demonstrate that specific criteria are met.
And what are some of those criteria that are important for investors to be aware of?
Yeah. So some of the key criteria include, demonstrating that the asset is technically feasible. So, it's actually possible to complete the asset so it can be used or sold.
Okay.
The company has to intend to complete the asset and use or sell it.
Okay.
They have to have the resources to complete the development.
Right.
It has to be probable that it's going to generate future economic benefits.
Okay.
And they have to be able to reliably measure the expenditure.
So it's a pretty high bar.
It is a pretty high bar. And there are some types of internally generated intangible assets that are explicitly prohibited from being recognized.
Okay. And this is important for investors to keep in mind.
It is. And so IAS 38 specifically says, no, you cannot recognize internally generated goodwill, brands, mastheads, publishing titles, customer lists, and similar items.
Right.
So this really highlights, this bias towards expensing a lot of the intangibles that a company creates itself.
Okay. So let's say an intangible asset meets all the criteria, gets recognized on the balance sheet.
Yeah.
How is it initially measured?
Yeah, so generally it's initially measured at cost.
Hmm.
And the cost, includes all the necessary expenditures to get that asset ready for its intended use.
Okay.
So, that could be the purchase price if you acquire it externally, or it could be the development costs
Right.
if you've created it internally. Now, if it's part of a business combination,
Okay.
then the cost is actually its fair value at the acquisition date.
Okay. So once the intangible asset's been recognized, what are the different ways that its value can be shown over time?
Yeah, so after initial recognition, you have two main options. You've got the cost model, which is the simplest and most common, where you basically show the asset at its original cost,
Right.
less any accumulated amortization and impairment losses.
Yep.
And then you have the revaluation model, which, as the name suggests,
Yeah.
allows you to revalue the asset to fair value. But this is much less common for intangible assets because, as we've talked about, it requires you to be able to determine fair value by reference to an active market. And, for many intangible assets, that's
Yeah.
just not possible.
Okay. Now, this concept of amortization is important for intangible assets that have a finite useful life. So how does that work?
Yeah, so amortization is basically the process of spreading the cost of that intangible asset over its estimated useful life.
Right.
So it's kind of like depreciation, but for intangible assets.
Okay.
And so this amortization expense is recognized typically in the profit and loss, although sometimes it can be included in the cost of other assets. So, for example, if the intangible asset is used in the production of inventory,
Right.
you might include the amortization in the cost of that inventory. Now, intangible assets that are considered to have an indefinite useful life, well, Those are not amortized.
Okay.
But they do have to be tested for impairment at least annually. So that's basically just checking to see if the value of the asset has declined
Okay.
below its carrying amount on the balance sheet.
Okay. The sources also touch on how IAS 38 applies in some specific situations, such as cloud computing arrangements. So how should investors think about those?
Yeah. I mean, cloud computing is ubiquitous these days.
Right.
It's everywhere. And so the accounting can be a little bit tricky.
Okay.
But the key thing is whether the customer, so the company that's using the cloud computing service, recognizes an intangible asset.
Okay.
And this hinges on whether they essentially have a software lease. So what does that mean? That means they have the right to use substantially all of the economic benefits of the software throughout the contract term.
Yeah.
If they do, then they would recognize an intangible asset. However, if it's not a software lease or they don't otherwise obtain control of the software at the commencement of the contract, well, then it's just treated as a service.
Okay.
And they just recognize the expenses as they use the service.
Okay. And then another area that's kind of relevant for investors in certain industries is extractive activities. So things like mining, oil, and gas. How are those exploration and evaluation costs accounted for?
Yeah, so this is a bit of a special case, and IFRS actually has a separate standard, IFRS, that specifically deals with exploration and evaluation expenditures. And it actually acknowledges that, there are different views on whether these costs even meet the definition of an asset in the first place. So IFRS 6, says, look, we're going to assume that these expenditures could give rise to an asset.
Okay.
But recognizing them as such is only appropriate if it provides useful information to the primary users of the financial statements, which would be investors. So, generally, IFRS 38 would require research costs to be expensed.
Right.
But IFRS 6 does allow you to capitalize exploration and evaluation expenditures in certain specific circumstances.
Okay. And then finally, the academic research seems to have some conflicting findings on whether it's more useful for investors if companies capitalize or expense R&D costs.
Yeah, and I think this is a really interesting area. I think the academic research really doesn't give you a clear-cut answer.
Okay.
So, there are studies that suggest that, capitalizing R&D can actually lead to companies providing more voluntary disclosures.
Okay.
And it can also make stock prices more informative to investors. So, in other words, the market is actually able to incorporate that information into the stock price. However, there are other studies that find that expensing R&D immediately might actually be as good or even better at explaining market values.
Okay.
And then there are even some studies that have found that, capitalizing R&D under IAS 38 might actually make analysts' forecasts less accurate. So, it's a really interesting area. I think it just highlights the fact that, there's still a lot of debate about the best approach.
Yeah, it seems like more research is needed.
Yeah.
And what about the overall usefulness of the intangible assets that are actually recognized in financial statements for investors?
Yeah. So there's been some research looking at this, and it suggests that, strategically important intangible assets that are recognized as part of a business combination, so when one company buys another company, those intangible assets can actually provide more information to investors than just the goodwill that's also recorded. So, if you break out the value of the brands, the patents, the customer relationships, that can be more useful than just having this big lump sum goodwill number.
Right.
However, intangible assets that are not strategically important or that are easily replaced, those might not be as informative.
Okay.
And then, there's a bigger question, I think, which is, are financial statements in general becoming less relevant?
Right. Expert speaker.